Something just happened in the silver market that has not happened in over 40 years. In the span of just 11 trading sessions, silver ripped from $31.40 to $89.20 per ounce. That is a 184% move. Not in a year, not in 6 months, in 11 days. Let that sink in. Banks that were short silver at $33, $35, $40. They are now staring at losses that are, in some cases, existential. We are talking about margin calls so violent that the COMEX clearing system was reportedly stress tested for the first time since the Hunt brothers crisis of 1980. Traders on the floor of the exchange described it as a slow-motion nuclear event. Everyone could see it coming, nobody could stop it. And here's the part that should make your jaw drop. The shorts are not just trapped. They are trapped at $89 to $90, a price level where covering is mathematically catastrophic, and where the physical market has essentially gone dark. There is no silver to buy. The lease rates have exploded. The London forward market froze for 6 hours on Tuesday morning. And the COMEX registered inventories, the actual ounces available for delivery, dropped to their lowest level since 2001. Think about that for a second. The market that has been called the most manipulated commodity market in the world just snapped the chain. And we are going to walk through exactly what happened, why it happened, what the math says about where this goes next, and what the extreme scenario looks like if the shorts cannot cover. Stay with me, because this is the most important silver video I have ever made. To understand what just happened, you need to understand the structure of the silver market. Silver trades in two worlds simultaneously. There is the paper market, futures contracts traded on the COMEX in New York, and the LBMA in London, where the notional value of silver traded every single day is roughly 250 to 300 times the amount of physical silver that actually exists above ground. Write that again, 250 to 300 times. This is the leverage that has allowed bullion banks to suppress the price for decades by creating synthetic supply out of thin air. And then there is the physical market. Real metal, real ounces, real delivery. For years, even decades, these two markets moved together because the paper market was large enough to overwhelm any physical demand signal. If prices started rising too fast, a bank would dump 10,000 contracts, 50 million ounces of paper silver, into the market in seconds and crush the price. We have seen it on the charts hundreds of times. That vertical waterfall at 3 a.m. London time, that suspicious dump right when the New York Open happens. The silver community has documented it obsessively for years. But here's what changed. Industrial demand for silver did not just grow. It accelerated beyond every single projection made by the Silver Institute, by the mining analysts, by the ETF managers. Solar panel installations globally hit 680 gigawatts in the last 12 months. Each gigawatt of solar capacity requires roughly 1 million ounces of silver. Do that math. That is 680 million ounces from solar alone in 1 year. And the total annual mine supply of silver on this planet is only 820 million ounces. So solar by itself consumed 83% of global mine supply. Before you add electronics, before you add medical applications, before you add jewelry, before you add investment demand. This is where things get interesting. The deficit was always there. The analysts knew, the mining companies knew. But as long as the paper market could paper over the physical shortage, literally, the price could be managed. Until the physical buyers stopped accepting paper promises. Until industrial users, who need actual silver to make actual products, started demanding delivery. Until the COMEX registered inventory fell so low that a single large delivery demand could break the system. And that is exactly what happened. Now let's zoom out to the macro picture, because the silver squeeze did not happen in a vacuum. The US dollar index broke down through 98.40 in early trading 3 weeks ago. That was a critical technical level. It was the neckline of a 2-year head and shoulders top on the DXY. When it broke, every systematic macro fund in the world went short the dollar simultaneously. We are talking about algorithmic triggers at Citadel, Millennium, Renaissance, the big quant shops, all hitting the same signal at the same moment. A weaker dollar is rocket fuel for commodities priced in dollars. It is not complicated. If the dollar loses 10% of its value, a commodity priced in dollars needs to rise 10% just to stay flat in real terms. When the DXY broke 98, it was pricing in a dollar that was heading toward 92, maybe 88. That alone was worth $10 to $15 of upside in silver. Then there was oil. Brent crude crossed $112 per barrel the same week. Why does oil matter for silver? 2 reasons. First, energy is the single largest input cost in silver mining. When oil goes to $112, the marginal cost of production for silver rises dramatically. The all-in sustaining cost for the average silver miner goes from roughly 22 per ounce to somewhere between 27 and $30 per ounce. The floor under silver prices rises mechanically with oil. Second, and this is the geopolitical dimension, High oil prices signal that the petrodollar system is under genuine stress. When oil producers like Saudi Arabia, Russia, and the Gulf states start pricing oil in yuan, in euros, in gold-backed instruments, the dollar's structural demand from oil transactions begins to erode, and every percentage point of erosion in dollar demand is a percentage point of gain in hard asset demand. Gold moves first, silver follows, but it follows harder and faster because the market is smaller and the shorts are more concentrated. Now add the war premium. Two major conflicts are simultaneously draining strategic reserves of silver-intensive military hardware. Guided munitions, electronic warfare systems, satellite communications equipment, all of it uses silver in quantities that defense agencies have not publicly disclosed. But the procurement orders are visible in the supply chain data. Defense contractors placed silver orders 340% above their 5-year average run rate in the last 2 quarters. 340%. Think about that. And meanwhile, central banks globally are cutting rates. The Federal Reserve pivoted first, then the ECB, then the Bank of England. Falling interest rates reduce the opportunity cost of holding non-yielding assets like silver. Every 25 basis point cut from the Fed is worth roughly $2 to 3 in silver price support based on historical elasticity models. When you stack a dollar breakdown, a commodity cost floor rising with oil, a geopolitical defense demand surge, and a global rate cutting cycle, you do not get a silver rally. You get a silver explosion. Let's talk about the technical picture and the ratios. The gold-silver ratio is the single most important relationship in precious metals analysis. Historically, the ratio has averaged between 47 and 55 over the very long run, meaning it has typically taken 47 to 55 ounces of silver to buy 1 ounce of gold. When the ratio is high, say 80, 90 or above, silver is historically cheap relative to gold and tends to mean revert aggressively. When silver's current move started, the gold-silver ratio was sitting at 91. That was extreme. It was in the top 3% of all historical readings going back 120 years. The last time the ratio was this extreme was in March 2020, when it hit 124 during the COVID crash, right before silver tripled in price in the following 18 months. Now here is the math. Gold at time of writing is approximately $380 per ounce. If the gold-silver ratio were to revert to its historical average of 50, which it has done repeatedly after major periods of silver undervaluation, the implied silver price would be 3,180 divided by 50, which equals 63.60. But we are not in a normal reversion. We are in a squeeze. We are in a physical delivery crisis. We are in a macro environment where every single tailwind is blowing simultaneously. The last time conditions like this aligned was 2011, and in 2011, the gold-silver ratio compressed all the way down to 31.67 at the peak. If the ratio compresses to 32 with gold at 3,180, the implied silver price is $3,180 divided by 32, which equals 99.38. And this is where things get interesting. Because silver at $89, where the shorts are currently trapped, represents a gold-silver ratio of approximately 35.7. The market has already done 80% of the work to reach the 2011 compression extreme. The shorts are defending a level that the fundamental math says should already have been broken. Beyond the ratio, the commitment of traders' data, the Kiat report, tells an alarming story. The commercial short position in silver, held primarily by 4 to 8 large banks, reached a record gross short position of 87,000 contracts earlier this year. At 5,000 ounces per contract, that is 435 million ounces of silver sold short, against registered COMEX inventory at the time of only 112 million ounces. The short position was 3.88 times the available deliverable supply. Let that sink in. This is the structural vulnerability that the physical buyers exploited. They simply demanded delivery. And the math of covering 87,000 contracts of shorts, buying back 435 million paper ounces in a market where physical supply is collapsing, is mathematically violent. Now here is the math on price targets, and I want to be very precise here because precision matters. Starting point, silver was at $31.40 when the move began. First target was the 2011 all-time high of $49.80. Silver blew through that in 3 days. Second target was the measured move from the 2020 base at 11.64 to the 2021 high at 29.42, projected forward. That range is 17.78. Added to the breakout level of 49.80, the measured move target was 67.58. Silver blew through that too. Third target came from a Fibonacci extension model. taking the entire 2020 to 2021 range and projecting the 2.618 Fibonacci extension from the breakout at $49.80 gives a target of $49.80, plus silver is currently at $89.20. It is 93% of the way to the 2.618 Fibonacci extension target. Now here's the short squeeze math. There are approximately 52,000 contracts still short on the COMEX as of the most recent chaotic data. At 5,000 ounces per contract, that is 260 million ounces. The registered inventory available for delivery is currently 67 million ounces. The ratio of short ounces to deliverable ounces is 3.88 to 1. For every $1 that silver moves higher, the mark-to-market loss on those 52,000 short contracts increases by $260 million. At 89, the cumulative loss on the original short position placed at an average of $34 is approximately 55 per ounce, multiplied by 260 million ounces, which equals 14.3 billion. These are not small numbers. These are bank-breaking numbers. The critical level is $90. That is where stop losses for the largest short positions are clustered based on options market positioning data. The $90 strike has the single largest open interest of any option strike on the COMEX. When silver clears $90 convincingly, those stops trigger, and the algorithmic buying cascade begins. Conservative estimates from the options positioning model suggest a $90 clearance could add $8 to $12 per ounce in the immediate subsequent move. That puts the next technical target at $98 to $102. Let's go back in history because this has happened before, and understanding what happened before tells us exactly what happens next. In 1980, the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, attempted to corner the silver market. They accumulated roughly 100 million ounces of physical silver in a massive futures position. Silver ran from $6 per ounce in 1979 to $49.45 on January 18, 1980. The move was 724% in 14 months. The COMEX responded by changing the rules. They implemented Silver Rule 7, which allowed only liquidation orders. No new long positions. The market collapsed. Silver crashed from $49.45 to $10.80 in 8 weeks. But here's the difference between 1980 and today. In 1980, the physical silver demand was primarily investment-driven. When the rule change killed investment demand, the price collapsed because the industrial necessity was not there. Today, the industrial demand is structural and growing. You cannot liquidate your way out of a solar panel manufacturer who needs silver to make photovoltaic cells. You cannot pass a rule that eliminates defense procurement. The industrial demand is inelastic. It does not go away because a bank changes the rules. Then there was 2011. Silver ran from 8.77 in October 2008 to 49.80 in April 2011. That was a 468% move. The gold-silver ratio compressed from 84 down to 31.67. Every single technical target was exceeded. The move was driven by a combination of QE1, QE2, dollar weakness, and growing industrial demand from the emerging solar sector. What stopped it in 2011 was 5 consecutive margin hikes by the CME Group in 8 days. They raised initial margin requirements for silver from $11,138 per contract to $21,600 per contract, a 94% increase in the cost of holding silver longs. It forced leveraged longs out of the market and broke the momentum. Could they do that again? Technically, yes. But here's the problem. Last time, the physical market was not strained. Last time, registered inventory was ample. Last time, the industrial deficit did not exist at this scale. If they raise margins today and force longs out, physical buyers who are taking delivery will simply step in and absorb the paper selling. The arbitrage between the paper price and the physical price would become visible and embarrassing in a way that the regulators cannot ignore. The playbook from 1980 and 2011 has been read. The market has prepared for it, and the structural conditions today are far more powerful than either of those episodes. Let's get into the actual mechanics of what is happening right now in the physical market, because this is where the story really accelerates. The COMEX registered inventory, the ounces available and ready for delivery, against futures contracts has fallen from a peak of 151 million ounces in early 2021 to approximately 67 million ounces today. That is a 56% decline in deliverable supply in 3 years. At the current rate of delivery demands, COMEX registered inventory is being drawn down at approximately 4.2 million ounces per week. At that rate, total registered inventory would be exhausted in 16 weeks. 16 weeks. Now, inventory can be replenished. Eligible inventory, silver held in COMEX warehouses that has not been designated for delivery, can be reclassified as registered. There are approximately 280 million ounces in eligible storage, but reclassifying eligible silver requires the consent of the owner. And right now, owners of eligible silver are not consenting. They are watching the price go up, and they are choosing to hold. Why would you turn your silver over at $89 when the math says $99 is coming? The physical premium market tells the same story. Silver Eagles, the U.S. Mint owns 1 ounce silver coins, are trading at 16 to 18 above the spot price. A year ago, the premium was 4 to 5. Silver bars at 100 ounces are trading at 350 to 450 over spot. The wholesale premium market, which should be near zero in a normally functioning market, is screaming that physical supply is acutely tight. And the lease rate story is extraordinary. Silver lease rates, the cost of borrowing silver to deliver against short positions, have gone from 0.8% annualized to 14.3% annualized in 3 weeks. Let that sink in. It costs 14.3% per year to borrow silver. That is a cost that destroys the economics of any carry trade or short position almost instantaneously. Industrial users are beginning to panic buy. We are getting reports from procurement departments at major electronics manufacturers and solar panel producers that they are placing forward contracts to lock in silver supply for the next 12 to 18 months. Every forward purchase takes physical supply off the market and tightens the squeeze further. This is a self-reinforcing cycle. Rising prices trigger industrial hoarding. Industrial hoarding tightens supply. Tighter supply pushes prices higher. Higher prices trigger more industrial hoarding. The shorts are caught in this spiral with nowhere to go. So where does this go from here? Let me give you the price roadmap. $90 is the immediate resistance and the critical psychological level. This is where the largest concentration of short stops is clustered. This is the level the banks are defending with everything they have. Every time silver approaches $89.50, you see heavy selling pressure. They are fighting for their lives at this level. But they are fighting a losing battle because the physical market is eating their paper silver alive. A clean daily close above $90 on strong volume, and I am talking 180,000 contracts or more, triggers the algorithmic cascade. Target from that breakout is $96 to $98, based on the momentum indicators and the Fibonacci extension model I showed you earlier. $100 is the next massive psychological barrier. Round numbers always attract selling. There will be a battle at $100. But given the fundamentals, given the deficit math, given the COT structure, $100 is a speed bump on this move, not a ceiling. Between $100 and $110, there is relatively light technical resistance. The 3.0 Fibonacci extension of the 2020 move lands at $103.14. The 3.618 extension lands at $114.20. These are the levels where momentum traders and trend followers will be adding long exposure aggressively. Above $110, the market enters what technical analysts call price discovery mode. There is no overhead supply from previous price history because no one alive has seen silver at 110. The only guides are the Fibonacci projections, the gold-silver ratio targets, and the fundamental deficit math. If the gold-silver ratio compresses to 28, which is one standard deviation below the 2011 peak compression of 31.67, reflecting the deeper fundamental deficit today, and gold is at $3,180, the implied silver price is $3,180 divided by 28, which equals $113.57. If gold continues its own bull market to $3,500 by year-end, which the positioning in gold futures suggests is conservative, then a 28 gold-silver ratio implies silver at 125. Write those numbers down. Now let me walk you through the extreme scenario. Because in markets like this, the extreme scenario has a habit of becoming the base case. If the COMEX registered inventory continues to drain at the current rate, the exchange faces a situation that has only happened once in modern history. A force majeure, a declaration that physical delivery cannot be made. In that scenario, the exchange settles contracts in cash at a price set by the exchange. The longs would be paid a settlement price. The paper price would collapse in the moment of force majeure because there is no more futures market to express upside price discovery. But, and this is crucial, the physical silver price would immediately diverge from the paper price. Industrial buyers and physical investors would have no choice but to bid in the over-the-counter market, the coin dealer market, the wholesale bar market. The physical price could trade at a massive premium to whatever settlement price the COMEX announces. We saw a version of this in the palladium market in 2001 when the NYMEX had a delivery crisis. Physical palladium traded at a $200 premium over the paper price for 3 months. If that happens in silver and the physical market clears at $130, $140, $150, the reported COMEX price becomes largely irrelevant for anyone trying to actually buy or sell metal. The scenario that the banks are most terrified of, the scenario that keeps the risk managers awake at 3 a.m., is a coordinated demand for physical delivery from multiple large players simultaneously. If 3 or 4 well-capitalized funds, sovereign wealth entities, Or industrial corporations simultaneously stood for delivery on their long contracts. The registered inventory would be exhausted within weeks. The shorts would have no legal path to deliver. The exchange would be forced into force majeure. This is not a conspiracy theory. This is the arithmetic of the market. The short position is larger than the available supply. That is simply true. The only question is whether the longs choose to press their legal right to delivery. And every day that passes at these prices, the incentive to press that right grows larger. Under the most aggressive scenario, force majeure, physical price divergence, global industrial panic buying, and sovereign level accumulation, silver could print $150 to $200 within 12 months. That is a 68% to 124% move from current levels. The math supports it, the physical deficit supports it, the macroeconomic environment supports it, and the structural vulnerability of the short side supports it. Here's where we stand. Silver has just made the most violent move in 4 decades. The shorts are trapped at $89 to $90 with losses that are historically unprecedented. The physical market is under acute stress with registered inventory at 22-year lows. Industrial demand has permanently consumed the structural supply surplus that allowed price management for decades. The dollar is breaking down. Oil is rising. Central banks are cutting rates. Geopolitical demand for silver-intensive defense systems is exploding. And the gold-silver ratio math says we are 80% of the way to the 2011 compression extreme, with far stronger fundamentals than 2011 ever had. The near-term roadmap is $90 breakout, leading to $96 to $98, then a battle at $100, then price discovery all the way to $113 to $125 on the ratio compression model. The extreme scenario, which is no longer extreme given the delivery math, puts silver at $150 to $200 on a 12 to 18-month view. And this is where things get interesting one final time. We are at the moment in the silver story where the weight of evidence has become so overwhelming that the market can no longer be managed. The paper chain is breaking. The physical reality is asserting itself. Every buyer of physical silver in the last 3 years is sitting on life-changing gains. Every short seller who thought this was just another manipulation-suppressed commodity is staring into an abyss. History will look back at this moment as the turning point, the moment the most manipulated market in the world finally found its true price. Now I want to hear from you. Do you think silver breaks $90 this week? Do you think the COMEX faces a force majeure? Are you holding physical silver or mining stocks? Drop your position and your price target in the comments right now. I read every single comment. And if you found this analysis valuable, if this gave you a framework for understanding what is happening in real time, hit that subscribe button. Because this story is nowhere near over. The next move in silver could be the biggest in a generation, and you do not want to miss a single update. Disclaimer note to include, in description, this script is for entertainment and educational purposes only. Nothing in this video constitutes financial advice. Silver markets are highly volatile. Always conduct your own research before making any investment decisions.